Buy the dip now, and if it goes to 4,000, buy more.
Physical gold or gold miners?
Both.
Silver, catch
But
up
the
or
miners are
overhyped?
cheaper. Excuse me?
Silver, catch
Last
up or
question.
overhyped?
Buy it. It's a breakout. Buy this dip.
AI, opportunity or bubble?
Both.
Nvidia, generational leader or peak hype?
Peak hype.
Real estate, high rates kill the market or inflation keeps prices high?
Well, it's a combination of both. It depends on the market, the location. This is a very unhealthy market. I mean, I think the whole story behind Bitcoin has broke. In fact, look at what Saylor has to do now. When a year ago, he was able to sell 0% preferreds, 0% interest, because people really wanted exposure to Bitcoin. He can't do that anymore because they don't want the exposure to Bitcoin. He has to bribe them with an 11.5% yield. So people are saying, I don't care about Bitcoin anymore. I don't want the upside of Bitcoin. Give me that 11% yield. That's what's going on. So the whole story is broken. Yes, Bitcoin is not at zero yet. You can still get a lot of money if you sell your Bitcoin, but no one's making any money buying it. It's not going to be the new gold. It's not digital gold. It's not going to replace the dollar. It's not going to replace anything. The whole thing was a giant Ponzi. It was a decentralized Ponzi, pyramid, blockchain letter. The fact that it gets so much attention from the financial community without criticism. The fact that the SEC is not coming after Michael Saylor, which is ridiculous. I mean, they would never let me get away with what they're letting Saylor get away with. They'd probably shut down my whole business if I was promoting something the way he is.
Okay, so you're not buying Bitcoin, but you are buying gold. And gold already had a big move, but it is, 20% off the high.
When you zoom out, the signal isn't coming from one analyst, it's coming from the bond market, the currency market, and the commodity complex simultaneously. Peter Schiff has been mapping this sequence for years. Bonds break first, then the dollar, then equities reprice violently. What you're about to hear isn't a prediction. It's a post-mortem on a structure that is already failing. The only variable left is timing.
And so you have to be prepared for that. You know, the U.S. economy is in a lot of trouble, much more than is generally perceived. I think we're on the verge of not just a financial crisis, but a U.S. dollar and sovereign debt crisis. So I think U.S. stocks, which are extremely expensive by any conventional way to measure stock value, even the bulls will concede that they're expensive. They just expect them to stay expensive. But there's a lot of risk that when you're priced for perfection, you're not going to get it, and the markets are going to be repriced. And now you have the war, which I think people are underestimating the significance of this war, how much damage it's going to do to the U.S. economy, to the budget of the United States, to the credibility of the United States, and to long-term interest rates and inflation. So the markets, I think, are really looking past a lot of problems and pricing stops based on hope and not reality. I think if you look at where yields are compared to where they were a few years ago, in fact, yields are much higher today than they were before the Fed started cutting rates. So I think the bonds have already broke. They haven't just broke down. Stocks, of course, haven't even broken yet because they've just hit new highs. So I think you've seen a breakdown in crypto, a breakdown in bonds. I think the dollar hasn't really broken down, but it's topping out. And gold is clearly broken out. So has silver. I think oil has too now. I think, and other commodities. Look at copper. So I think this is a breakout in the commodity markets, and generally a commodity bull market is not good news for the bond market. And if we're going to have a bear market in bonds, it's going to be hard for the stock market to shrug that off.
Do you believe that AI is included in the everything bubble? Is AI a bubble? And should investors have exposure to names like Nvidia in their portfolio?
Well, I don't know if AI itself is a bubble, just like the internet wasn't a bubble. But many stocks that, got caught up in that as .com stocks, there was a bubble there. Just like airlines, railroads weren't a bubble, but there was a bubble in railroad stocks. I mean, railroads did a lot to transform America.
So you said that investors need to prepare for the downturn. If you're right, how should they be positioned?
Well, they could take profits if they've been investing in the U.S. market for some time. They should have some nice profits. They should get out, and they should look to alternatives. One would be precious metals, gold and silver, but there are also stocks. You could get into resource stocks, mining stocks, precious metals, industrial metals, energy stocks, although they've run up a bit, but I still think they're going higher. Other commodity agricultural plays. Look at the emerging markets. A lot of value still there. and even developed markets outside the U.S. that I think where the stocks are much better valued, where you don't have these, sky high, valuations with these PEs and high PEs and low dividend yields, and countries that will benefit from the weakness of the dollar and strength in overseas markets. All those benefits are being priced into a handful of stocks as if they're going to be the beneficiaries. But it should be average businesses that end up benefiting from AI.
Do you have exposure to those stocks in your portfolio?
Well, look, personally, I have some exposure to like tech stocks. Like I own Taiwan Semiconductor myself. We own that in our emerging market fund. Obviously, TSM benefits because it makes all this stuff, right? A lot of the stuff, not Nvidia's GPUs, but it makes a lot of these chips. I have other companies. Personally, I own this company called Delta Electronics, which is now the biggest company in Thailand. When I bought it, it was pretty insignificant. It's now about 100 times what I paid for it. And the reason it went up so much was because it really got into AI. Now, I probably should sell it, but I haven't. I just I've hung on to it. And I have, a tremendous gain in it. Obviously, percentage-wise, it's the biggest gainer in my portfolio. It's not quite the biggest position in my portfolio, but it's one of them. But
do you have any Mag 7 in your portfolio?
Huh?
Do you have any Mag 7 in your portfolio?
No, I don't have any of the Mag 7 names, whether it's people on the Fed or people at part of the presidential economic advisors. So many things that nobody else saw coming, that people in fact specifically said were impossible to happen, that I predicted have already happened. So much has already happened to validate what I've been saying, that the odds that this is all random coincidence and that I'm somehow wrong, I think are very slim. The only thing that hasn't happened yet is the ultimate collapse, the ultimate crash that is the consequence of all these forecasts that have already come true. So the only thing is the timing. I don't know exactly when the whole thing is going to implode, but all the pieces of that puzzle are coming together. All the things that I've been saying would happen are happening or have happened. So
let me ask it a different way.
I could be early.
Yeah, no, I meant what would make you wrong. But let me ask it this way. What would make you bullish on stocks from here?
Oh, on U.S. stocks?
Yeah.
Well, if they went down a lot, then I could get bullish. I mean, obviously, if they got cheap, I would get bullish. And I still think over time.
This isn't a bear case. It's a sequencing map. Crypto's narrative fractured the moment. Saylor had to offer an 11.5% yield to attract capital that once lined up for zero. Bonds confirmed the breakdown when the 1-0 failed to rally. After 4 consecutive Fed cuts, yields moved higher, not lower, which is the textbook signature of a sovereign credibility problem. Gold and silver didn't break out in spite of this. They broke out because of it. Fast, violent, and ahead of the equity market. Repricing that hasn't happened yet. The rotation Schiff describes out of US equities, out of crypto, out of dollar-denominated bonds, and into physical metals, miners, and commodity-linked emerging markets is not a contrarian trade. It is the historically normal response to a late-stage fiat credit cycle. In 1979, gold moved from $226 to $843 in under 14 months, as the dollar's credibility eroded under similar fiscal pressure. Copper is already confirming the commodity breakout. Silver has not yet matched gold's percentage move, which means the catch-up, when it comes, will be sharp and compressed. The real risk isn't holding gold at current levels, it's holding cash and overvalued US equities when the equity market finally reads the same memo the bond market already sent.